Hello traders, today we will talk about Fibonacci in the role of support and resistance. When we define support and resistance with Fibonacci, for example, we'll take this currency pair, stretch Fibonacci from the top to the bottom, and mark the most important Fibonacci retracement, which is 0.618. This line represents a resistance line from which we can expect some price reaction. In the case that the price breaches this resistance, as we mentioned in the previous lesson, then the resistance becomes a support from which we expect bounce and growth. But this is not the case with Fibonacci. After a break of resistance determined by just a level of Fibonacci, it does not become a support, but next level of Fibonacci is taken as a resistance. So forget the breached level of Fibonacci. It no longer exists and we cannot use it for further analysis. We'll open the gold chart and run the Fibonacci from the beginning to the end of this wave. As we see, the first two levels are breached and they are no longer of any use to us, and you can forget them. The next levels are the levels of support from which we expect the price to react and continue to the path of the initial trend. Each level of Fibonacci can be marked as a separate level of support. Support 1, support 2, and support 3. If the entry into the buy trade is made on the first support, a stop loss should be set under the second support. If the entry into the buy trade is made on the second support, stop loss should be set under the third support. If the trade is set at level 78.6, stop loss should be set under the previous bottom. Okay, the next example. The currency pair New Zealand US dollar. On the chart we see a downtrend. We will use this whole wave and start the Fibonacci from the top to the bottom. Pay attention on the level 38.2. It was resistance. Now it's broken. So what do you mean? Is this level now support for us? Should we go into buy if price sells to that level? Absolutely not. Forget about that level. It does not have any meaning for us, as the levels 23.6 and 50 because they are also broken. The first level that has some significance for us is level 61.8. This is the first level of resistance from which we expect reaction. If the price breaches this level, we'll also ignore it and pay attention to the next level. If we open the sell trade at 61.8 level, stop loss should be set above 78.6. If we open the sell trade at the 78.6 level, we should set the stop loss above previous stop. Now, you should never open a trade at each of these levels. For example, if you open a sell trade on the first level of support and the price jumps and closes your position with a loss, never make the entry immediately on the next level into a sell. So if you lose again, open the trade on the next and so on. This is absolutely wrong. To open a trading position, one level is always used, or a zone around that level, which we choose at the potentially best level where the retrace could be stopped and after which the price could start in the direction of the initial trend. In addition to Fibonacci, to determine that level, other tools of technical analysis, trend lines, channels, technical patterns, support and resistance determined by the previous bottom and tops, Fibonacci clusters, and so on are used. If in one narrow zone there is more than one support or resistance determined by different technical analysis tools, or if several Fibonacci levels coincide in a narrow zone, we receive support or resistance that gives us good chances for successful trade. What's it all about you will see in the next part of the course. We will be doing a little more advanced analysis with Fibonacci, We'll combine the Fibonacci levels with other technical analysis tools and explain Fibonacci clusters. Okay, that's it, and we'll see you in the next part of the course. Bye.